Should you buy existing multi-unit apartment buildings and rent them out, or develop a property from scratch and sell it at a higher profit? That's the decision you have to make when entering the real estate arena. You can either be a real estate developer or a real estate investor, depending on your expertise and the funds that you have to invest. In some cases, you can be both at the same time. But the decision should be based on knowledge of the pros and cons of each. When real estate development can attract you with higher profit chances, the risk associated with it cannot be overlooked. As for real estate investment, you can buy rental units and have a steady income, but you would never get a profit upfront as you can if you developed and sold a property. So, should you be a real estate developer or a real estate investor? Hello there, I'm Manyara Kerago, a personal finance coach. In this video, I will help you decide whether you should become a real estate investor or a real estate developer. I will explain the advantages and disadvantages of each option so that you know everything before you even start. At the end of the video, you will have decided on a clear roadmap of how you should enter real estate. If you need help to ensure that you get the best outcome with your finances, I'm available for your support. Please check out my do-it-yourself online course, my one-on-one financial freedom coaching, and Eternity Real Estate program from the links in the description below. If you like this kind of content, please subscribe and share it with anybody you know who you think might benefit from it. Also, ring the bell icon to be notified each time I post a new video. So let's get started. Before I tell you about the pros and cons, let's first establish what a real estate investor and a real estate developer are. A real estate investor buys properties to generate income by renting them out. For this purpose, various types of properties such as residential houses, multifamily units, commercial buildings can be bought with the intention of renting them out. In some cases, these properties can also be sold, but the prime focus is always rental income. In contrast, a real estate developer buys land and constructs properties to sell them at a profit. He can either target the acquisition of land or existing properties with ambitious plans for significant changes, whether it's constructing new buildings, renovating existing ones, or repurposing the land for entirely new projects. The focus will be to develop and sell the properties at a profit. Now let's see the pros and cons of being a real estate developer. First, let's talk about the pros. Number one, potentially high return on investment. During the construction of a property from scratch, a real estate developer has the opportunity to enhance profit by overseeing various aspects of the venture, including design, construction, quality, and provided amenities. Developers can create properties that command premium prices by carefully managing expenses and understanding market demands. This results in larger profit margins compared to purchasing existing properties. Additionally, starting from scratch enables developers to capitalize on emerging trends and market needs, increasing the potential for enhanced profits. Ultimately, developing real estate from beginning offers the prospects of greater financial gains by producing distinctive, sought-after properties that meet market requirements. Because you're turning land into a property ready for anyone to settle in, you get to pocket all the profits that could have gone to various parties. Number two, there is often a shorter length of investment period. The advantage of a shorter investment duration in real estate development lies in swiftly earning profits once the property is sold after construction. This is very different from rental properties where the profits trickle in monthly. In real estate development, you can get instant cash to reinvest to continue the cycle and multiply your profits repeatedly. Number three, is investment leverage. Leverage can enhance your purchasing power. When acquiring property, you can buy more with less capital. This is achieved by investing your own funds and securing additional financing from a bank through bridging capital and a mortgage. Leveraging works in your favor by enabling you control a larger asset base with a relatively small initial investment. This approach allows you to spread your investment across multiple properties or undertake larger development projects that might otherwise be financially unfeasible. Because you don't need the entire construction cost at the same time, you can plan to construct a great property and divide the costs in the upcoming months. On the other hand, we have the cons. Number 1, delays in project completion. This is a nightmare for real estate developers because it upsets the entire investment plan. Firstly, delays can result in increased costs due to extended construction periods. These additional expenses may include higher labor costs, materials cost, and overhead expenses, all of which can diminish the project's budget and reduce profit margins. Moreover, delays in project completion can lead to missed opportunities in the market. In the dynamic real estate landscape, timing is crucial, and delays may mean that the property enters the market when the demand has decreased or competitors have already secured a larger market share. This can prolong marketing efforts and potentially result in lower selling prices, affecting the project's overall profitability. From a logistical perspective, delays can disrupt the project schedule and lead to further delays for subsequent phases or related projects. This can trigger a chain reaction, causing delays and cost overruns across multiple projects and negatively impact the developer's overall portfolio and reputation. Number 2 is the higher risks. Because a real estate developer is constructing a property from scratch, the risks involved are higher due to uncertainty at every phase. One significant risk is financial in nature. Real estate development projects typically demand significant upfront investment in land acquisition, construction, permits, and other expenses. If market conditions unexpectedly shift, such as an economic downturn or changes in local regulations, developers may struggle to regain their investment, leading to financial setbacks or even bankruptcy. Furthermore, market risk is a major concern in real estate development. Property demand can fluctuate due to the economic conditions, demographics, or consumer preference changes. Developers may encounter hurdles in selling or leasing properties if unfavorable market conditions result in lower than expected revenues or prolonged holding periods, which can increase carrying costs and reduce overall returns. Number 3 is the high barrier to entry. Not everyone can afford to be a real estate developer because of the higher hurdles one has to cross. This is because of a significant investment needed to initiate real estate development projects, which could prevent potential newcomers from entering the market. You should know that real estate development demands substantial upfront financial resources for land acquisition, construction expenses, permits, and various other costs. These high capital requirements act as a barrier, limiting the ability of individuals or companies with limited financial means to enter the real estate development sector. Moreover, real estate projects are highly complex, requiring expertise in areas such as finance, construction management, legal matters, and market analysis. Acquiring these skills and knowledge can be time-consuming and resource-intensive, further exacerbating the entry barrier for newcomers. Established real estate development industry players may have already strengthened relationships with key stakeholders such as landowners, contractors, and financiers. These existing networks can give them a competitive edge over new entrants, making it even more challenging for them to enter the market. Now let's look at the pros and cons of being a real estate investor, starting with the pros. Number one, real estate can be purchased at below market prices. As a real estate investor in rental properties, you can always find properties below market price. This is because of fluctuations in the real estate market and sellers' urgency to sell because they need cash. Therefore, acquiring properties below their market value gives investors an immediate chance to increase equity. By purchasing properties at a reduced price, investors essentially acquire assets for less than their true value, rapidly boosting equity in the investment. Even though the property was bought at a lower price, it will bring more rent compared to the investment capital. Furthermore, properties purchased below market value offers investors a safety net. Even amidst market fluctuations or downturns, investors have a buffer as they acquire the property at a discounted price. This can help mitigate risks and offer protection against potential market instability. Number two is the steady cash inflows. Steady cash flow in the form of rental income is vital in real estate investment because it's the only earning source unless the property is sold. The reliability of consistent cash flows brings forth numerous benefits. First, rental properties offer predictable income streams stemming from regular rental payments, empowering the investors to plan and budget effectively. This reliability builds confidence as investors can anticipate the timing and the amount of the income. Secondly, steady cash flows reinforce the financial stability of real estate investments, covering essential expenses such as mortgage payments, property maintenance, and operational costs. This financial stability reduces the risk of financial strain. Additionally, for mortgage financing investors, steady cash flow provide a reliable source of funds to meet debt obligations, improving their financial standing. Dependable rental income even safeguards against unforeseen expenses or vacancies, providing a cushion during economic uncertainty or market fluctuations. The consistency of income also attracts favorable attention from lenders, making the property a less risky investment and potentially resulting in more favorable financing terms. Number three, real estate appreciates in value. Even though a real estate investor buys a property and rents it out, he does not unlock the full potential of the property until it is sold. As a real estate investor, you can decide to sell your rental property at a higher profit due to value appreciation and greater demand for rental properties in the market. But if you had not planned to sell, it's fine because your property will still pay you rent. Therefore, your rental property pays you twice. First, when you rent it. Second, it pays you more than what you paid for when you actually sell it. Number four, real estate provides an inflation hedge. Inflation, the general increase in prices of goods and services over time, reduces the purchasing power of money. However, your real estate, particularly rental properties, can serve as a hedge against inflation. It's because when the price of goods and services increase, so will your rental income. Therefore, the inflation you are facing will be balanced with the higher rent that you charge. As a property owner, you can adjust rental rates to keep up with inflation, ensuring that rental income remains in line with increasing expenses. This helps maintain or even improve the property's revenue in real terms, enabling investors to offset the effects of inflation on their cash flow. Moreover, real estate properties typically increase in value over the long term, often surpassing the inflation rate. As property values go up, they act as a hedge against inflation by preserving and potentially growing the investor's wealth. The increased demand for real estate driven by inflation can increase property prices, resulting in capital appreciation over time. This appreciation helps counteract the impact of inflation, allowing investors to uphold the purchasing power of their investments. On the other hand, we have the cons. Number one is that real estate investing is a long grind. Because you have a rental property, you only get small bits of the profit at a time. It's because you have to collect rent every month, and it's impossible to get all your future rent at once. When you buy a rental property, you accept to block your capital and receive a fraction of the profit every month. That's different from developing a property where you can unlock the whole profit the very moment when the property is sold. Number two is that real estate requires maintenance. Because you own rental property, you have to face continuous requirements for property upkeep and repair. Unlike other investment types that need minimal maintenance, rental property require consistent attention and financial investment to maintain their appeal to tenants and preserve their value. This maintenance includes various tasks like repairs, renovations, landscaping, and general property upkeep, all of which impose costs and time obligations on property owners. You might choose not to maintain your property, but this can result in reduced tenant satisfaction, higher vacancy rates, and decreased property value, ultimately affecting the investment's profitability and long-term viability. Number three is vacancies. If something scares real estate investors, it's vacancy in rental properties, resulting in lower rental income. During vacant periods, landlords can still encounter expenses such as mortgage payments, property maintenance, utilities, without enough rental income to cover these costs. This scenario leads to financial pressure and reduces profitability. Furthermore, vacancies can impact cash flow, disturbing the budget the property owner had made by relying on rental income. Sometimes mortgage payments can be delayed and the whole portfolio can be disturbed. After knowing the pros and cons of each option, you can now decide which is better for you. The right choice depends on your preferences. If you want to generate passive income and build long-term wealth, becoming a real estate investor would be better. However, if you have skills in constructing new properties or renovating existing ones and are willing to take the risks for potentially higher profits, becoming a real estate developer would be your choice. Would you like to be a real estate investor or a real estate developer? Or do you believe you can do both, depending on the situation? In the comment section right below, share your thoughts about which option brings more profit and which option is safe. If you want to learn in more detail how you too can generate passive income through real estate investing so that you can finally gain financial freedom, then what you need to do is watch my free training. Click the link in the description below to get immediate access. If you love this video, give it a like and subscribe to the channel for practical insights on financial freedom, personal finance, and financial literacy. Thank you for watching.